In this video about bite-sized accounting topics, we will learn how to consolidate fully owned subsidiaries under IFRS. You are watching Accounting Zero to Hero. A fully owned subsidiary pertains to an investment which is owned 100% by the parent. It implies that there are no non-controlling interests in the structure. Consolidating a fully owned subsidiary can be a simple exercise, and you only need to remember the following mnemonic: H for harmonization, C for combination, and E for elimination. Let's discuss each of them using a sample exercise. Harmonization means that all entities that you should be consolidating comply to three main rules. Number one, they use the same accounting standards and they apply these standards consistently within the group. In this example, we assume both entities have been converted into IFRS so that all line items are consistently presented using the same rules. Number two, they are presented in the same currency. Of course, you cannot add two items of different currencies. You need to ensure that foreign operations or subsidiaries with a different presentation currency as the group are converted in the same presentation currency as the parent. This topic is covered by IAS 21 and we have posted a video about it in the past. The link is in the description. Here, we are showing that all entities have already been converted into euro. Lastly, make sure that they are using the same accounting period. The accounting period should also be aligned so that the balance sheet date and the period covering the income statement are the same across all entities in the structure. However, IFRS allows differences in accounting period as long as the difference is not more than 3 months. Here we show that all entities are covering a 12-month period ending December 31, 20x3. Consolidation involves adding balances line by line for all entities, and the harmonization process ensures consistency across the whole structure. In this specific example, debits are presented as positive and credits are presented as negative both in the balance sheet and in the income statement. Combination simply means combining all financial statement items line by line without thinking of the consolidation adjustments. In this step, you need to just ensure that each combined balance is composed of items that are alike and that the intercompany accounts such as these are easily identifiable. This will make the next step a lot easier. Now, the most interesting part of the consolidation process is E, elimination. This means exactly what it says. We are eliminating all intercompany items within the combined balances. This ensures that, number one, the individual line items in the assets, liabilities, income, and expenses do not include internally generated items. And number two, the combined equity section shows as if it is of one legal entity, which is the parent. Now, there could be a lot of different types of eliminating entries, but they would generally fall into the following categories. Number one, elimination of investment accounts against the subsidiary's equity. Number two, elimination of intercompany assets and liabilities. Number three, elimination of intercompany income and expenses. Number four, elimination of intercompany dividends. And last but not the least is the elimination of intercompany profits. These 5 sets of eliminating entries would be the most common that you will encounter in practice. Knowing all of them would make you proficient in IFRS consolidations for fully owned subsidiaries. Let's discuss them one by one. The first elimination you will encounter is the elimination of investment accounts against the subsidiary's equity. For a subsidiary that was established by the parent normally would have a debit in investment and subsidiary account and a credit to cash. In turn, the subsidiary will receive this cash by debiting it and credit its own share capital. In the eliminating entry, you just need to cancel out the transaction by debiting share capital of the subsidiary and crediting the investment in subsidiary in the parent's books. There is a whole lot of complications when the subsidiary is acquired by the parent through a business combination. We will deal with that in a future discussion. The second type of elimination is the elimination of intercompany assets and liabilities. This can happen when, for example, the parent lends cash to the subsidiary. In this case, the parent debited intercompany receivable and credited cash. The subsidiary, upon receiving the cash, credits intercompany payable and debits the same amount to the cash account. In effect, there is no real movement in cash at group level, but we need to eliminate the receivable and the payable through an eliminating entry. In this case, we need to credit the intercompany receivable and debit the intercompany payable to eliminate both balances. Elimination adjustment number 3 is about intercompany income and expenses. This can happen when, for example, there are payments of interests related to the intercompany loans. The parent would normally earn interest income from the cash they lent, and the subsidiary will normally incur interest expense from the transaction. Assuming the subsidiary paid for this interest expense in cash, the parent will debit cash and credit interest income, while the subsidiary will debit interest expense and credit cash to represent the payment to the parent. At group level, there really is no interest income or expense. This leaves us with a gross amount of interest income and expense that we need to eliminate in the profit and loss statement at group level. The balance sheet is not affected since the cash movements cancel each other out. For here, we simply debit interest income and credit interest expense in the eliminating entry. The fourth one is the elimination of intercompany dividends. Sometimes, the subsidiary declares and pays dividends to the parent. In this scenario, when the parent receives a dividend, it debits cash and credits dividend income. However, in the accounting books of the subsidiary, it debits retained earnings or dividend distributions and credits cash. The dividend distribution account is an equity account. At group level, there is no real dividend income and there is no real movement in retained earnings. That is why we need to post an eliminating journal entry by debiting dividend income to cancel it out and crediting retained earnings or dividend distributions to restore the consolidated books into its previous state before the dividend payment. Last but not the least is the elimination of intercompany profits. This can happen when there are intercompany sales within the group that generate profits for one entity. But since the asset that was sold stayed within the consolidated group, or it means it wasn't sold to a third party, these intercompany profits should be eliminated. For example, we assume that the parent company sold a bunch of inventory to the subsidiary for a sales price of 100,000 euros. The cost of the inventory that was sold was 80,000. In the books of the parent, we debited cash for 100,000 and credit sales revenue for the same amount. We also debited cost of goods sold for 80,000 and credit inventory for 80,000 to represent the cost of the sold asset. In the books of the subsidiary, upon receipt of the inventory from the parent, it debits inventory for 100,000 and credits cash for 100,000. What happened here is that at the subsidiary level, the cost of the inventory that was sold started at 100,000 even though it only really costed 80,000 at the parent level. Our job now is to restore the balances as if there was no intercompany sale that happened. In this case, we need to debit sales revenue by 100,000 to remove it from the P&L, credit cost of goods sold by 80,000 to also remove it from the income statement. You will notice that we will have a net credit remaining, and it's amounting to 20,000. It will be adjusted against the inventory account because this represents the intercompany profits that overstated the inventory in the balance sheet. After this adjustment, you will notice that the inventory account is now back to the original cost before the sale. Now the next thing to do is to simply add all the items line by line from the combined balances column to the eliminating entries that we identified. The resulting balances are what we call the consolidated balance sheet and the consolidated profit or loss. You will notice that in the balance sheet and P&L, we have effectively removed all the intercompany items. Even in the income statement, you will see that we started with so many lines of income statement items, but we determined all throughout our adjusting entries that most of the items in the income statement are actually intercompany items. In the equity section, you will notice that the share capital remaining is the share capital of the parent, because these consolidated financial statements are prepared as if it is one legal entity only, which is the parent company. I hope you found this video super helpful. Practice this and you will be a consolidation expert in no time. See you in the future installments of the Bite-Sized Accounting series.